Hey everyone, welcome back to the show. So, I've got something special today. Something that's been sitting on my desk, begging me to crack it open, and now that I have, I'm buzzing to share it with you. It's a book called Buffett and Munger Unscripted: 3 Decades of Investment and Business Insights from the Berkshire Hathaway Annual Shareholder Meetings, put together by Alex W. Morris. Yeah, it's a mouthful, but trust me, it's worth every syllable. This isn't just another finance tom. It's a goldmine of raw, unfiltered wisdom from Warren Buffett and Charlie Munger, 2 legends who've shaped how we think about money, business, and life. I stumbled across it after a friend mentioned it's like having a front row seat to 30 years of their best Q&As, and I'm hooked. Today, I'm kicking off a deep dive into this beast because it's massive, and we're starting with Part 1, Value Investing. Let's get into it. First, the book itself. Alex Morris, the guy behind this, isn't just a fanboy. He's a sleuth. He's gone through every Berkshire Hathaway annual meeting from 1994 to 2024, 31 years, over 700 questions, and cherry-picked around 500 answers that pack the most punch. That's 3 decades of Buffett and Munger riffing off shareholders. No script, just straight talk. Published in 2024 by Harriman House, it's 300-plus pages of distilled brilliance, organized into 13 parts covering everything from value investing to insurance, economics, and even their takes on Coca-Cola and Guy-O. Morris drew inspiration from Larry Cunningham's The Essays of Warren Buffett, aiming to do for the meetings what Cunningham did for Buffett's letters. Make the wisdom accessible, theme by theme. He's even donating half his after-tax proceeds to Guide, a charity Buffett loves, which adds a cool vibe to the whole thing. Dedications to his family, mom, dad, sister Amanda, wife Jessica, son Jack, give it a personal touch too. This isn't a quick read. It's a journey, and since it's so extensive, I'm breaking it down into parts for you over the next few episodes. Today's just the start. Value investing, and we'll roll from there. So, why is this book a big deal? Buffett and Munger aren't your typical Wall Street suits. They've built Berkshire Hathaway into a juggernaut. Think 500 billion under management. By sticking to principles that feel almost old school in today's algo trading, meme stock world of 2025, these annual meetings in Omaha were like their yearly sermon. Shareholders flocking to hear them unpack their moves, their misses, and their mindset. Before 2018, you had to be there or catch scribbled notes online. Then Berkshire dropped videos going back to 94. And Morris turned that treasure trove into this book. It's not about politics or life hacks, though they've got zingers on those. It's laser focused on business and investing, straight from the source. Let's set the stage. Buffett, born 1930, and Munger, 1924, are Omaha's dynamic duo. Buffett's the folksy oracle, Munger's the sharp-tongued sage. They've been at this since the 60s, turning Berkshire from a failing textile mill into a holding company owning chunks of Coca-Cola, American Express, and whole businesses like See's Candies and BNSF Railway. Their secret: value investing, buying great businesses cheap and holding forever. But it's not just a formula, it's a way of thinking. And in Part 1, Morris lays out 24 subtopics, like stock selection, business quality, and patience, pulling from meetings between 94 and 23. I'll hit the highlights today, weaving in their own words, and tease what's coming next. All right? Value Investing 101 with Buffett and Munger. At the 2009 meeting, Buffett kicks it off. Charlie, and I think there's no other kind of investment than a value investment. We don't know how anybody would invest in a non-value investment. He's baffled by the label, like, what else would you do? To him, it's simple. Value is getting a lot for the expectable future cash flows in terms of what you're laying out today. Whether it's a stock or a whole company, you're betting on future cash discounted back. Munger nods along, but in 2012 he takes a swipe at academia. The folly creeps into the accounting too. He's talking black, Scholl's options pricing. Fancy math that misses the point. Buffett agrees. Investing is really not that complicated. I'd have 2 courses: how to value a business and how to think about markets. Forget portfolio theory or beta. They're obsessed with understanding businesses, not chasing formulas. That's the core know what you're buying. In 98, Buffett lays out stock selection. We're looking for a business we can understand. Then we try to figure out whether the economics, the earnings power over the next 5, 10, or 15 years is likely to be good and getting better. It's like buying a gas station. You'd check competition, future prospects, management, price. Munger chimes in with a gem from the same meeting. When finance is properly taught, it should be taught from cases where the investment decision is easy. He loves the National Cash Register story. A fanatic founder, killer patents, a no-brainer in its day. They want obvious winners, not head-scratchers. Business qualities next, and in 2003, Buffett's dreaming. The ideal business earns very high returns on capital and can keep using lots of capital at those high returns. That becomes a compounding machine. Think 20% on 100 million, then 120 million on 144 million exponential growth. Problem is those are rare. Coca-Cola or See's candies don't require much capital, he says, and extra cash doesn't juice returns. Munger's blunt. We hate that kind of business, where profits just sit there or get stuck, like used construction equipment rusting in a yard. Berkshire's edge. They shuffle cash from great, but limited businesses to buy more, like a chess grandmaster moving pieces. Success in business and investing. It's a marathon. In 98, Buffett's practical. Learn all the accounting you can work at a number of businesses. Talk with people in business. Experience builds judgment. Munger adds, underspending your income year after year really works. Start young. Compound interest is a snowball on sticky snow. Buffett says in 99. By 2004, Charlie's watching Buffett evolve. He's learned a hell of a lot, even in the last 20 or 30 years. Temperament trumps IQ. Buffett in 2009, if you have an IQ of 150, sell 30 points, you need emotional stability. Munger's savage. If you think your IQ is 160 and it's 150, you're a disaster. It's about staying calm when the market's screaming. Patience is huge. In on 95. Buffett's waiting for the fat pitch. A baseball analogy for the perfect swing. You don't have to be right about every company, he says in 98. You have to make a few good decisions in your lifetime. They skip the unpredictable. Charlie in 2007. Why throw almost all decisions into the too hard pile, and we just sift for a few that are easy? Buffett. We don't know how to jump over 7-foot bars, but we know how to recognize a 1-foot bar. It's not rocket science, it's discipline. Risk's a biggie, and they flip the script. In 94, Buffett defines it: the possibility of harm or injury inextricably wound up in your time horizon. Day trading Coca-Cola? Risky. Holding it for decades? Near zero. Volatility is not a measure of risk to us, he says in 98. Academia's beta. Nonsense. Munger agrees. As long as the odds are in our favor, We don't mind volatility. They'd rather a sure thing bounce around. Lets them buy more cheap. In 2001, Buffett's adamant. You can find wonderful businesses that have great volatility. It doesn't make them bad. A cash is a hot topic. In 94, Buffett's clear, if we have cash, it's because we haven't found anything intelligent to do with it. Oh, we'd like to have no cash at all times. It's not about market timing. It's about waiting for deals. By 2006, he's got 14 billion sitting. We don't like having excess cash, but we like even less doing dumb deals. Munger's chill. Why manage to put an awful lot of wonderful stuff into Berkshire in the last 10 years? In 19, they're still hoarding. 10 billion's the floor. Because when it's raining gold, Buffett wants to go outside with billions ready. Research is low-tech. In 94, Buffett shrugs. The speed of information really doesn't make any difference. It's the processing and coming to some judgment. Annual reports. A few calls done. We can make decisions very fast, he says. In 98, he's teaching. Identify the key variables. How predictable they are. If something's not very predictable, forget it. Munger's skeptical of over-analysis. You can't appraise every company like a real estate appraiser. Buffett's final exam. Value an internet stock. Answer it, you flunk. They dodge declining businesses. In 2012, Munger notes, declining businesses are not worth nearly as much as growing ones, but they can still be valuable if a lot of cash comes out. Buffett's wary. It pays to stay away. The real money is going to be made in the growing businesses. No cigar butts. Those puff wonders, unless it's a steal. Due diligence. Buffett in 2014 recalls his 23-year-old self-grilling coal CEOs. Which company would you bet on, and which would you short? Simple, effective. Public versus private markets. In 94, Buffett prefers stocks. The market is far more inefficient. You get a chance to buy businesses at foolish prices. Whole companies face formidable competition from LBO funds using other people's money. Munger's dry. They tend to be somewhat optimistic. Stocks let them snag pieces of giants like Coca-Cola, unbuyable outright. By 2023, the game's tougher. Munger's gloomy. Value investors are going to have a harder time. Now are so many smart people competing. Buffett's upbeat. What gives you opportunities is other people doing dumb things. There's been a great increase in that. Short-term noise is their edge. Think 5, 10, 20 years out, not quarterly earnings calls. So, what's the takeaway? Value investing isn't a trick. It's a mindset. Understand the business, buy it cheap, hold it long, skip the noise, the fads, the bullshit earnings. Buffett's 1998 jab at EBITDA. It's about curiosity, discipline, and knowing your limits. They've missed big ones. Google, Amazon, but owned their flubs and kept swinging. Now, this is just part 1, 24 subtopics, and I've hit the biggies. The book's got 12 more parts. Valuation, capital allocation, Berkshire's inner workings, insurance, economics, even sees candies and GI so. It's a beast, right? I could ramble all day, but I'd rather stretch this out, unpack it piece by piece. Next time, we'll dive into part 2. Valuation and intrinsic value. How they size up a business's worth, from discounted cash flows to paying up for quality. It's where the rubber meets the road, and I'm stoked to dig in. For now, grab As Buffett and Munger Unscripted if you can. It's a slog at 300 pages, but every page sparks something. I'm still chewing on Buffett's fat pitch line, waiting for the right moment, so 2025, with all our instant, everything chaos. What do you think? Could you sit on cash like they do, or are you itching to swing? Hit me up. Let's chat about it. I'll catch you soon with more from this gem. Plenty left to unpack, and I'm just getting warmed up.